Hello everyone and welcome in this project. Let's start with the company. Hoogland Outdoors is an imaginary company that resembles the outdoor retail in Netherlands that sells outdoor gear and apparel. In addition, this project is complete commercial diagnostic for Dutch outdoor retailer. Think of it as a store or the company like North Face, Patagonia, Columbia, or any lifestyle companies such as Nike, Adidas, JD Sport, etc. Now, Hoogland has been operating in Netherlands through its 55 stores and one B2C channel in Netherlands. This project covers the full year of data. I built the entire analytics stack, the data warehouse, the dashboard, and the statistical analysis. And every single finding is quantified in euros because a finding without a number is just an opinion. So before I go further, let me introduce here. I'm Herschel, and I'm a data analyst here in Netherlands, an ordinary engineer who knows now business. I have been working in this domain, outdoor and sporting good retail, since a couple of years now, across different roles and capacity. But this project deliberately goes beyond what I do at work. The tech stack, the statistical method, and strategic recommendation. These are the capabilities I built through my MBA and present and past experience. This is what happens when domain expertise meet an analytical engineering. Let me walk you through how this project was built and what it revealed. Before I show you the architecture or the code, let me show you the result. Three numbers that would change how this business operates. 40.5 million euros, that is how much margin the promotional calendar destroyed over the two-year of period of time. So this number is aggregated. Every single one of eating campaigns. Now, what is promotional campaigns such as Black Friday sales? Ran below. So every single of 18 campaigns ran below the company's baseline margin. Every company established their baseline margin, then our profit margin should be at least from this to this range. And all 18 campaigns ran below that company's baseline margin. The promotion brought revenue, but they gave away the profit margin, 116 million euros. That is how much working capital is trapped into a product that barely sells. The bottom half of the product catalog, 310 product, for example, that generates 4.6 revenue. That is 4.6% of the total sale. That is insane. But the classical problem supply chain that 80% revenue is generated by 20% of the product, but the rest of the 80% product cannot be able to sometimes generate the 20% of the revenue. But this sits on the shelves and tying up the cash. Now, 7.1 million euros, that is the annual revenue gap from the stores that underperform compared to their other peers. 25 out of 54 physical stores are leaving money on the table. 5 out of 6 hypotheses were confirmed. One was rejected. And that rejection was just valuable because it told the business when not to worry. Now, let me show you how I got there. But before, let's just talk about what are the hypotheses that we have established for this research. So one is that, of course, the promotional and return on investment illusion, margin destruction. Then second hypothesis is all about the store allocation variance, like revenue per square meter. Then the third hypothesis is all about channel cannibalization, like e-commerce or store growth. Then fourth would be weather demand coupling, so temperature regression. So if weather is changed, then is an impact on the sales. Then loyalty asymmetry, like it's about the how loyalty card and how customers you've been associated with. And the hypothesis six is Pareto SKU concentration, long tail inventory. So we'll discuss further one by one in the next upcoming chapters. This project I have created in the form of sprint. Initial period, I built the data warehouse. Now let me explain what that means in plain language. The business had its own data that scatters across 13 different CSV files. Sales transaction, inventory record, customer profiles, campaign details, even daily weather data. This data or these files were raw. Columns names were inconsistent. Data type were mixed up. There were gaps and duplicates. So you cannot run your reliable analysis on this messy data. So I have used for this project DBT and DuckDBT. So what is DuckDBT? Or you can say Duck database, DuckDB. Think of it as, let's say, a high-speed filing cabinet for analytics. Unlike traditional database that needs server running somewhere, DuckDB here is just a single file on your computer, 165 megabyte. That's it. No server, no cloud, no monthly bill. It is built specifically for this kind of work or this kind of project that requires scanning millions of raw, grouping them, aggregating them, spitting out answer fast, and connect all the like files, all the, I mean, you can say, because here there is a stage called mart in that database. this mart you can connect with the Power BI and Python that can read from same file, which means there is one source of truth. Nobody is looking at different numbers. Now DBT, that is transformation engine. It takes those 30 messy CSV files and transform them into three layers of cleaning and enrichment. Think of it as a factory assembly line. Now, as you can see, I have opened the VS Code and I have selected the folder Hoogland Outdoors, where I can see the raw data that is in CSV file form. The data here are scattered and each file represents from where it belongs. Dimension tables such as store, product, campaign, etc. and fact tables such as sales, return, supply orders, etc. So on the left hand side, you can see those raw data. And the first, now we are talking about the DBT. In the first layer of staging, which you can see in the middle figure, in the staging, the 13 models. So this is simply uploading those CSV into the DBT, and that is for staging. Now this is quality department. It takes the raw data and cleans it, renames the columns so that they are consistent, convert text dates into actual dates, remove duplicates, and no business decision actually happen here. It just makes the data more trustworthy. But on the other hand, if you just see in the middle figure a little above, that is the intermediate, which is the 5 models, that is assembly floor. This is where the single sales transaction get connected to the store it happened, the product it was sold, the customer who bought it, and the campaign that was running at the time. All of the business logic, joins, aggregate, enrichment, calculated fields, they lives in this layer. Moving further, you can see in the middle figure, the middle portion, the marks, the 5 models, these are the finished product rolling off for the assembly line. 5 analytic tables, each designed to answer specific set of business question. One for store performance, one for promotional effectiveness, if you can see in the middle of this figure, and one for customer lifetime value, one for inventory health, and one for weather-driven demand. Now here is a critical architecture constraint. And this is important because each Power BI dashboard page reads from exactly one mart. So this all mart are directly connected with the Power BI and the Jupyter Notebook. So there is no point of mixing it, no joining the table inside the Power BI. Why? Because we apply all the business logic as per the stakeholder, all here in this mart or in the intermediate stage. So if you can see the top right figure, in that you see one mart store performance table that I have opened. And this is for not the same sales count twice, or by locking each page to each mart, to each Power BI, it it is traceable. If any stakeholder have some issues or have something to feedback on, then it can be traceable with the single SQL query. So if somebody from stakeholders challenges this number, then I can show them exactly where it came from, and that is auditable by design. And you can see the data flow at the bottom. So, I mean, in this particular, I mean, the previous slide, we can see the 13 staging models, which fed 5 intermediate model, which produce 5 mart, and then it consumed by 2 tools such as Power BI and the Jupyter Notebook. I connected the Duck database warehouse to Power BI using a special connector called MotherDuck and built 6 dashboard pages. Page number 1, the commercial overview. Revenue is 199 million for 2025, up to 2.5% versus the last year. Margin is 45.5%, and the basket is 163 euros. What's basket? The basket is the average price for each transaction in the store. So it's a mean value for each sale. These are the headline KPIs. So we have discussed about basket, we have talked about the margin, and we also talk about the revenue realized for 2025. And you can toggle between 2024 and 2025 to see the year-over-year movement. Page number 2, the store performance drops to individual store level. Now that this is where you start seeing the variance. Some stores do 29 euros per square meter, others do 4 euro. That's squared is the signal that led hypothesis to. The promotional effectiveness, that's page number 3, is the most commercially dangerous page. 18 campaigns, as I said previously, campaigns, this promotional campaigns like Black Friday, 18 campaigns generated 214 million in promotion revenue. But the promotion margin is 30.8%, while the company's full year baseline is 45.4%. There is 15% point gap. That is the first sign that something is going wrong here. Page number 4, 5, and 6 covers customer CLV. What is CLV? Customer's lifetime value. Each company has their own customer and each customer has their own lifetime value. So we talk about the customer CLV, then inventory health, and weather demand. Each reads from its own mark. Remember that we have created mark in the database that we have, so each answers a specific business question. The customer page shows 80,000 loyalty members and reveals that the two loyalty tiers are essentially identical. The inventory page shows 363 stock out SKUs. What is SKUs? A stock keeping unit. Each product has their own identity and nearly 80 weeks of average stock cover. The weather page shows how temperature drives the revenue in a predictable way. Also the forecast pattern as well. Uh, so this 6 pages, 6 hypotheses addressed. But the dashboard only tells you what is happening. It does not tell you why, and it does not tell you how much it costs. That is what we are going to cover in the notebook, and that is what you can see in the further. Now for statistical analysis, I built a Jupyter notebook that is Python coding environment, and I connected it to the same database warehouse. Same data, different lens. The dashboard shows what is happening. The notebook tests whether it is statistically real and quantifies the cost. So hypothesis one was the biggest finding of this entire project. I tested every single one of 18 campaigns against the company's full year baseline margin of 45.4%. The result, not a single campaign, again, not a single campaign made it above their profit margin line. Not even single. Look at the chart here. Campaign type promotion, 8 of them destroyed 19.5 million euros in margin. Uitverkoop means clearing the sale. The Dutch word here, uitverkoop, is the clearing the sale. Ran 4 times and destroyed 11.5 million. Now Black Friday destroyed 5.5 million. And gifting campaign, Sinterklaas Cares, destroyed 4 million. But here is the nuance. Look at the margin number on the right hand side. Uitverkoop drops to 14% to 18% margin. That is 30% point because our industry standard is 45%. And Outverco is just create 14 point to 18% margin. So this 30% point baseline, it is essentially giving product away. Now Black Friday sits 25%. Regular campaign sits at 35%. But gifting turns 39% to 40%. That is close to baseline. Gifting nearly works. Now this total margin that destroyed over two year of period, it's around 40 million. So this is roughly 40,500,000 euros. If I divide it by 2, it's 20 million a year. So the recommendation we carried out from this whole statistics that we need to destroy the Outverkoop, restructure the Black Friday, and protect the gifting. It is the only format approaching acceptable margin level, and shift the promotion strategy to conditional mechanics such as buy two, get one free. Here is that called 2E half price. It means the second one is a half price. So you need to buy one and the second one is in half price. Loyalty exclusive pricing, bundle offers, things that protect margin while still driving the traffic. The target should be 8 million euros per year in margin recovery. Is the product catalog too wide? I ranked all 620 products by how many units they sell. The donut on the left-hand side tells the story. The top 20% of the products generates 82% of the revenue. That is sharper than the classic 80-20 rule. The middle 30% generates about 40% of the sale. And bottom half, which is 310 products, generates just 4.6% of the sale. But here is the punchline. That bottom half is sitting on the 116 million euros in inventory. Product nobody is buying, taking up warehouse space, shelf space, and tying up the cash that could have invested somewhere else. The bar chart on the right hand side shows where the dead stock is concentrated. Apparel technical, think as a high-end technical jacket and layering products. That holds 50 million euros in trapped inventories. 118 products, so such as hiking holds 23 million, ski and winter holds 21 million. The recommendation is start ranging rationalization. So rationalization program in apparel technical. So exit the product that sells fewer than 500 units a year and cost more than 300,000 to carry. A 30 a 30% reduction in the long tail releases approximately 35 million euros in working capital. That is cash the business can redeploy. Are stores allocated efficiently? This chart compares revenue per square meter across the four store archetype. City center store generate 24 euros per square meter. Suburban store generate 17. Regional store generates 16. And the outlet store generate 4 euro. That is 5.5 times gap between the best and the worst archetype. But the real insight is not between the archetype, it is within them. So 25 of 54 physical stores sits below their own archetype median. These are not outlet stores dragging the average down. These are the city center stores with large footprint that should be performing well, but they are not. The three biggest underperformers, Amersfoort, leaving 880,000 euros on the table annually, Utrecht, just 818,000, and Arnhem, which is followed by 787,000. These are all city center stores. Combined annual revenue gap 7.1 million euros. The recommendation here, a store by store diagnostic on the bottom 10, not spreadsheet exercise, an actual visit. Test whether the gap is driven by staffing level, floor layout, local competition, or a catchment area. Prioritize Amersfoort and Utrecht because they have the largest footprint, which means the upside per euro of intervention is highest. Three more findings, each with its own chart. Top left, weather coupling. I ran a linear regression, essentially asking the data for every degree of a temperature goes up, how much does revenue change? The answer depends on the category. So hiking gains, the category of hiking gains 8,089 euros per day for every degree of warmer. That makes sense. Warmer weather drives people outdoors. Ski and winter losses 5,203 euros per day when it warms up. And subsequently, camping has the tightest statistical fit, an R square of 0.65, making it most forecastable category in the entire catalog. 7 out of 9 categories showed statistically significant sensitivity. If the Netherlands has warm season, say let's say 5 degree above the average for 120 days, hiking gains 4.9 million euros, ski losses 3.1 million, and the next exposure is 1.7 million. This is forecastable risk that should be built into inventory planning. Furthermore, on the top right side, it's a loyalty asymmetry. The loyalty program has two tiers, Plus and Premium Plus. I expected the premium tier to show higher engagement, but it doesn't. The two tiers are statistically identical. Same average customer lifetime value, same purchase frequency, same recency, and same RFM scores. The tier structure is decorative. It does nothing. But here is where it gets interesting. The real asymmetry is not between the tiers, it is within the customer base. Top 10% of the customers have lifetime value of 7,423 euros, while bottom 10% for 433 euros. So you can see the difference. There is almost 17.2 times gap. The top 10% generate 28% of all customers value, and the program does not recognize for the so the program does not recognize them or does not reward them. And so here the strategic recommendation could be scrap the two-tier model, replace it with the 3 or 4 tier based on the actual RFM score. Now, we previously talked about RFM score. What's RFM? So it's recency, frequency, and monitoring. Recency, it's all about how recently did they buy. Frequency is all about how often do they buy, and monitoring is like how much do they buy or how much they spend on. So we categorize them as to the platinum, gold, and silver. Concentration more on retention, like retention spend on platinum, growth and incentive in the gold, and reactivation campaigns on silver. Now, if you can see the bottom, which is channel cannibalization, this one was rejected. And that is good for the result. I tested whether e-commerce growth was eating up the store revenue. The monthly growth rate correlation between the two channels, online and offline, which is in-store, is 0.99995. That is nearly the perfect lockstep. When e-commerce has good month, store has also a good month. When e-commerce dipped, then the stores also dipped. Both channels grew year over year. E-commerce up to 3.5% and store is up to 2.8%. The e-commerce sales value moved from 27.8% to 27.9%. There is no cannibalization. The channels are complementary. The strategic risk here is actually the opposition. Under investing in e-commerce while it latest 28% versus the outdoor retail benchmark 35 to 40%. So what are we getting from this research? And what does the board member do with the help of this research? So in next 90 days, they need to restructure the promotional calendar. Kill the one of the promotion called out for go. So clearing the sale. That drops margin up to 14% and likely pulls demand forward rather than creating it. Restructure the Black Friday into more conditional format. So conditional format can be a shift to buy two get one, or maybe loyalty exclusive pricing, or it can be abundant offers. Furthermore, protect the gifting. It is the only format that nearly works. So the target should be 8 million euros per year in margin recovery by re-strategize this promotional. Now, furthermore, the range rationalization. Start with apparel technical. Some apparel that we accounted for 118 products sitting on 50 million euros in inventory that nobody buys. Exit products fewer than 500 annual unit. What does it mean? That if we are unable to sell less than 500 unit, those products we need to exit them from our inventory. And that furthermore condition is that more than 300,000 euros in carrying cost. So we need to scrap the unit that we are selling less than 500 annually, and the product or the inventory that carries the cost of 300,000 plus. And a 30% tail reduction releases approximately 35 million euros in working capital. So we can use this capital to redeploy into top performing categories. Move number 3 is diagnose the bottom 10 stores: Amersfoort, Utrecht, Arnhem, and 7 more. This is not the data exercise. It requires physical visit, operational review, test staffing, floor layout, local competition, catchment size. The price, if we are improving this, is 7.1 million euros in annual revenue currently left off on the table. At the bottom of the slide, the total addressable value, 53.6 million euros in margin profit that we can uplift across all confirmed findings, 116 million euros in trapped working capital identified for release. And importantly, the infrastructure I built is reusable. The Duck database warehouse or the DBT transformation pipeline, the Power BI dashboard, they do not expire after this analysis. Any future business hypothesis can be tested against the same warehouse. The diagnosis capability extends beyond this project. That is the end of the project that I have built for Hoogland Outdoors. 23 DBT models, 6 dashboard pages, 6 hypotheses tested, 5 confirmed, and 40 million euros in margin destruction identified. Further, 116 million in trapped capital, and 3 actionable moves for next 90 days. A full code, the DBT project, the Jupyter notebook, consulting report, README, and live dashboard is available on my GitHub. Link is in the description. Thank you for your time, and for such interesting project, let's connect on the LinkedIn.